Hey, just wanted to go ahead and get started here this evening. It's 6:30, so we wanted to be prompt and start on time. I want to thank everyone here for joining us on the Zoom. We won't keep you folks too long this evening. Just wanted to go through some of the information that was recently passed as part of the One Big Beautiful Bill, and just wanted to kind of go through and highlight some of the bullet points that we think are important. Um, Before we get started, I want to introduce myself. I probably know most of you, but if not, my name is Greg Dahlberg. I'm one of the advisors here at the firm. Been with the office for 25, going on 26 years. And tonight we're going to do this presentation through kind of a panel approach. So we're going to have a couple different speakers. We've got Adam that's going to join us here this evening and touch on a portion. Logan Meyer, Brett Naylor, Sharon is also going to touch on a piece, and we're each going to kind of walk through different sections. And when we get to the end, we will open it up for questions and answers. So if you do have any questions, we're going to hold them till the end, but there will be an opportunity. I think you can load questions as we go through the presentation. I think Logan's going to walk through them, and we'll do our best to get them all answered for you as we go here this evening. So keep in mind, a lot of the stuff we're going to cover this evening is as part of this bill. We're items passed by our good friends in Washington, and if you know how they like to do things in Washington, they like to get things passed first and then figure it out after the fact. And there's a couple of bullet points we're going to talk about tonight that things that have been passed, but they still haven't worked through all the final details yet. So we'll kind of explain some of that tonight as well. So with that, I think I'm going to pass it off to our first panelist. Logan is going to open up some slides and talk about some of the tax changes. And so with that, Logan, if you magically appear, and then I'm going to mute myself so I don't ramble over you, and then you can take it from here, Logan. So go ahead.
All right. Well, hello, everybody. My name is Logan. I've been at the firm for about 7 years now, if you haven't met me. Switch the slides over here. That should be changing for you. So I'm going to be talking about a few different tax items that were part of the bill that was passed. First step up here is Social Security tax. So big talking point here was that Social Security is not going to be taxable anymore. That is not true, and it's not even true at all. So it's really an age 65 rule. So at age 65, what they wrote in there, you can potentially have up to $6,000 bonus deduction, and it'll double if you're married filing jointly. So if you're married filing jointly, that 6,000 can go up to 12,000. And again, it's age 65, really has nothing to do with Social Security. So you could be 62 years old, drawing Social Security, but you're not that 65, so this deduction does not apply to you. You could be, say you're 67 and you are, say you're delaying Social Security, I'm waiting until 70, but you're 67, well, you're over 65, so this will apply to you. So it's really just an age 65 ruling here. And there are phase outs with it. So for single filers, it starts at 75,000 for income, excuse me. And married filing jointly doubles up to 150,000. And with that, the IRS hasn't been real clear if it's going to be phase outs after that, or if that's going to be a hard cap there. So still waiting on some determination from the IRS. If, say, for example, if you go $1,000 over that limit, are you going to get $100 less of the deduction, or if it's just a hard cap? Still waiting to hear on that. And this is something that's going to be in place until 2028. So we'll have it 25, it's in place this year, 26, 27, 28. So potentially we'll have 4 years of this. So if you're looking to take some extra money, go on vacations, might make a lot of sense to take some money out over these next couple of years here, if this bonus deduction applies for you, and really fill up those lower tax brackets. So creates a nice potential opportunity for us. Next up here, so this is the Social Security tax table. I'm not going to really go into this in detail. It's just showing you that Social Security, it's still taxable as it is today. So no change was made to how Social Security is taxable. Next up, auto loan interest deduction. So if you purchased a new vehicle this year, it had to been after December 31st of 2024. So purchase a new vehicle this year, you can potentially have some interest that you pay deducted. So if you go and finance a new purchase vehicle, you can get up to $10,000 of interest paid deducted. Little caveat, the vehicle has to be assembled in the US. So let's say you're looking to buy a Silverado, Some of them might be assembled here in Michigan. Some might be assembled in Mexico, and you might get unlucky and buy the one that was assembled in Mexico. So if you're looking to buy a new car, I would just make it a point to that whoever sales rep you're working with, say, hey, I heard there's potentially some tax benefits if I buy a new car that was assembled in the U.S., and make sure that if it's available, that you get the one that was assembled in the U.S. So if you did buy one already, it's easy to look up. You just take your VIN number, just punch it into Google, say, this is my VIN, was my car assembled in the U.S., and it'll pop right up for you. And if that's you and it says, yeah, I'll just bring it up to your CPA and say, hey, I think I qualify for this, and let them help you from there. There are some phase outs with it as well. On the slide here, it's 100,000 for single, 200,000 married filing jointly. And just like the last one, this phases out in 2028. So it's available for 4 years here. And then just to be clear, it's for purchases, not for leases. So it has to be a new purchase. The next slide here. All right, so tips and overtime. So another big talking point is no tips on, or no tax on tips, no tax on overtime. So let's start with tips. So the way that the bill reads, we can have up to $25,000 a year deductible for any tips that we may earn. So it's $25,000 per tax return. So say you're a single filer, you're going to get that $25,000. If you're married filing jointly, it does not double. It's still that $25,000. So it's $25,000 per tax return for the tips. And this is something you can take advantage of even if you itemize. So, I'm sorry, even if you take the standard deduction. So if you're taking, say you're married filing jointly and you're taking that 30-some thousand standard deduction, you receive tips, you can still take advantage of this and have some deductions there on the tips that you earned. Phase outs for this, $150,000 for single, $300,000 for married filing jointly. It's a little bit higher phase out limits than the previous ones we talked about. And again, the IRS hasn't been clear if there's going to be some kind of phase out range or if that 150 and 300 is just a hard cutoff. So if you look it up, there's a lot of people posting different stuff, what they're thinking. I wouldn't trust any of it because IRS hasn't said yet. So still waiting to hear what the IRS says. And same as everything else, this is in place until 2028. So we have 4 years of it here. And then jumping down to overtime. Overtime, they changed this a little bit, not sure why. I guess IRS just likes to make everything confusing, but $12,500 for single filers, you can potentially get deductible for overtime, and then $25,000 for married filing jointly. Has the same phase outs as the tip parameter there. Still in place until 2028, just like the tips are. And a little caveat for this one, on the overtime, it's only on your extra pay that you get. So let's say you work and you make $20 an hour, you work some overtime and they pay you $30 an hour. There's a $10 difference there. On that $10 difference, that's what's going to be available for the potential deduction, not the full 30, just the difference there. So your difference in the overtime pay. And this will be the last slide for me here. Above the line charitable deduction. So this was a permanent change that they made. And this is going to take place in 2026. So it's not in place this year yet. And this one is for those of us who take the standard deduction. So if you're charitably inclined, it's really hard to get above that standard deduction because of how large they are today. So this is something that's going to be added on top of that standard deduction for you. So if you're single and you give to charity or charity, church, or whatever it might be, you get $1,000 for single or $2,000 increased deduction for married filing jointly. The other note here, if you're eligible to do a QCD, a qualified charitable distribution, so you have to be 70 and a half to do a QCD, that is the most efficient way to give money still. So even though this is available, if you're 70 and a half and you can do a QCD, that is the most efficient way to give money for tax-wise. And that is the end of my slides. There's a Q&A box in here, so if anybody has any questions, just type them into the Q&A box, and once we're done with the presentation, we'll make sure we get them all answered. So Brett is going to be up next here, talking about
Everyone,
healthcare.
my name's Brett. I've been with the firm for just over 3 years. Tonight I'm going to cover a couple quick slides, 2 on Medicaid and the 1 on some changes to the earned income tax credit. Before I jump into my slide, I just want to quickly explain who this would apply to. So Medicaid is government-provided health insurance, and it's going to be applicable to individuals ages 19 to 64 for this slide. And someone would go on Medicaid if they have income filing single, less than 15,000, married filing joint under 26,000. So recipients must work, volunteer, or study to keep benefits as a part of the change with the big beautiful bill, and that's 80 hours per month or 20 hours a week. The big exemption is for parents and caretakers with children under the age of 13. There's also some additional exemptions listed, and these do not go into effect until January 1st of 2027, but the states do have the option to implement sooner if they choose to. And the feds did leave it up to the states to verify individuals' monthly work status at least every 6 months. And my next slide is a little bit different than the first one. So this is more, it's Medicaid eligibility, but for individuals older than age 65. There's now a home equity cap as a part of the big beautiful bill. Doesn't go in effect until January 1st of 2028. But this will be something new where on the federal level, if you have over $1 million in home equity, you would be disqualified to be on Medicaid. And this would be for individuals working with an elder law attorney for long-term care or assisted living. If you have multiple homes and values exceed over $1 million, you wouldn't qualify for Medicaid help. The big exemption I do want to point out is agriculturally zoned properties will be exempt. So farmers that might have the majority of their net worth tied up in land won't fall into this category for exclusions for Medicaid. And just made a note at the bottom there, if this is something that you think might apply to you in the future and you're concerned with, just suggest meeting with an elder law attorney, as they might be able to provide some further guidance on this. And then the changes to the earned income tax credit. So they expanded eligibility and phase-in for single filers without children and made it more inclusive for low income earners. But what the earned income tax credit is it provides additional refunds to low to moderate income families. So it depends on your marital status, income, and then if you have any children, as to how much of a credit you could receive. If you're married filing joint, have greater than $70,000 a year of gross income, you wouldn't qualify for any credits. Filing single, anything over $60,000 a year, you wouldn't qualify for any credits. But the maximum credit for 2025, assuming you have 3 children or more and fall into the income range, they increased by $216 to $8,046 for a refundable tax credit. So what a refundable tax credit is even if you don't owe any taxes, you can still qualify to get a refund back as a part of the earned income tax credit. And then there was an increase of $513 of the AGI phase-in. So that made it just widen the brackets to allow more people to be eligible for this. And the credit is only for individuals age 25 to 64. And to qualify, you must have a valid Social Security number, not be claimed as a dependent on another person's tax return, and live in the United States for more than half the year. And that is it for me. And I believe next up is Sharon with some additional changes.
Sure is. So, hi everyone. For those who don't know me, I'm Sharon, one of the other advisors in the office, and I've been here just under 4 years. So I'm just going to talk about some of the things about family. So it may not apply just to you, but you might be able to pass it on to your children or grandchildren. So the first one is the child tax credit. The child tax credit is for dependents younger than 17, and it was originally started back in 1997, and it is now getting a permanent boost. This was originally actually set to decrease at the end of this year, back to $1,000 per child, but it's now having a permanent increase of, and it's going up to $2,200 per child beginning this year. And it's going to index for inflation annually. The increased refundable portion of the credit is also here to stay, and that's set at $1,700 for 2025, and this will also increase each year with inflation. And for families with dependents who don't qualify, the $500 non-refundable dependent credit is now permanent as well. There is a phase out for this, and it's income exceeding 200,000 filing single or 400,000 for those filing married or joint. The next one is one that we've been waiting for a while. This one has had its first increase in nearly 40 years. So that's a significant amount, and it's to help cover the costs of childcare through the dependent care flexible spending accounts. This one starts next year, so 2026, and the maximum contribution is going to be $7,500. It used to be $5,000. The next one, the child and dependent care credit. So this is the one that helps families offset expenses incurred for the care of qualifying individuals. So this is for the costs of childcare for children under the age of 13, or for a spouse or dependent of any age who is physically or mentally incapable of self-care and lives with the taxpayer for more than half the year. Starting next year, so 2026, the bill raises the maximum dependent care rate to 50% for the lowest income taxpayers, and that's up from a previous maximum rate of 35%. It is maintaining the credit limits of $3,000 of expenses for one child and $6,000 for two or more. The rate does gradually decrease as your income increases, but the minimum care rate remains at 20%. The next one I'm dealing with is 529 plans. So I'm sure we're all familiar with these, but the well-known 529 plans are actually becoming more favorable as the annual tax-free withdrawal limit of K through 12 qualified education expenses is increasing from $10,000 to $20,000 starting next year, so 2026. Also, the definition of qualified expenses has been expanded to give more flexibility, and these are now going to cover things like tutoring services, educational therapies for students with disabilities, and for dual enrollment college costs, as just a few of them. The other section supporting is the non-traditional post-secondary education. And so it's been broadened as far as the definition of qualified higher education expenses. And so it's now including costs related to things like trade schools and vocational training. So that's a good thing too. The last slide that I'm going to cover is the Trump accounts. This one here, I'm going to give the caveat straight away. There's still a lot of unknown information on this. This is what we know so far. They're basically a new type of tax advantage savings account designed to help American children build long-term wealth. These accounts are a form of an individual retirement account designed for children under the age of 18 to promote early savings and investing that has tax-deferred growth. One of their highlights is these plans for all American children born from 2025, January 1st, 2025 through December 31st of 2028, will receive a one-time government-funded initial deposit of $1,000 into their Trump account. Starting next year, 2026, parents or others can contribute up to a maximum of $5,000 annually. This is after-tax money, and it will inflate, it will index for inflation. Just remember, contributions made are not tax deductible. One of the things we're really unsure about is where these are actually going to be opened, especially with the fact that these accounts must be invested in a mutual fund or an ETF with an annual fees or expenses not to exceed 0.1%. And they have to follow either the S&P 500 stock index or another index that comprises primarily of equity investments in US companies. Like IRAs, these have severe withdrawal limitations prior to age 59 and a half, with only a few exceptions to avoid the 10% IRS tax penalty, such as the first-time home purchase up to $10,000 and disability and qualified education expenses. We're not thinking that these accounts are even going to be available until mid-2026. And given all the technical nature of these accounts, it is likely that we're going to need guidance from the IRS with the regulations and how to implement these. Once again, if you've got any questions, drop them in the Q&A and we'll get to them at the end. Thanks, everyone. Now you're going to get Adam.
Thanks, Sharon. Hopefully you guys can see me and hear me now. And to finalize things, I've got kind of a miscellaneous slide to start with for some small business owners, which may or may not apply to everybody on the call, but we always like to provide more information, and maybe it is applicable to a friend, family member. And then from there, I'll kind of end with more tax stuff, but I would argue that does impact at least every single attendee on this webinar and pretty much every single American who's filing taxes. But first things first, we'll start with the Section 179 and Section 168K information. So really trying to give better tax breaks, if you will, for some of our small business owners. The Section 179, all that is in reference to is when we purchase qualifying equipment for our business. So think of that as, okay, I needed a new vehicle. I needed, the joke we've been using in the office is maybe we can get Wayne to buy us some new chairs in here to try to get some that are a little more comfortable. And we can say, hey, Wayne, don't forget the Section 179 approval rules applied to that. So the amount that you could expense in property was pretty significant, up to $1.25 million before. It's been increased to $2.5 million. And those phase out ranges, those are in reference to the total equipment property that you purchase. So under the new rules, if you buy total equipment over $6.5 million, you start to lose some of those tax benefits through Section 179. And for those who have any interest, essentially what you're able to do is get all of the tax benefits of purchasing that property in the tax year you put it in place, instead of having to spread it out over, let's say, 4 to 5 tax years. Then the Section 168 kind of bonus depreciation, it's extremely similar to that ending point I just talked about on 179, that you're getting to utilize all of those tax benefits in the tax year they happened. Just the biggest difference is 168 is available to anybody. There's no limits for the qualifying assets, where the 179 is for our small business owners. But you and I can sit here and say, if you're putting $6.5 million of equipment in place, how small are you on the grand scheme of things? It's all relative for sure. From there, we will pivot to, again, the things that I would argue are applicable to everybody here today. TCJA at the top, that was the Tax Cuts and Jobs Act, which many may be familiar with. That was kind of the last big, I'll say, tax legislation that occurred about 10 years ago now, 2016, 2017. And a lot of that was designed around changing our marginal tax rates and looking at kind of what our standard deductions are. We built this table here to show you what are the rates under the Tax Cuts and Jobs Act / with the one big beautiful bill. Those have actually been extended for, they say forever, but you and I all know that forever means until the next election cycle. So nothing here is permanent, but the rates under the TCJA column in the middle, that's kind of where we're looking at for marginal federal tax rates. And then all the way to the right, if you view the rates prior to the Tax Cuts and Jobs Act, that was actually what was supposed to happen if the one big beautiful bill didn't get passed. It was called the sunsetting of the Tax Cuts and Jobs Act provisions. So as we can see, most of those marginal rates were set to increase anywhere from 3 to 5% over time. So if nothing would have happened, you and I and everybody would have been paying more federal tax just as a rate of that sunset provision. And then the standard deduction is at the bottom as well. here in 2025 and moving forward with the continuation of the One Big Beautiful Bill. For single individuals, we can offset the first $15,750 of our income through a standard deduction. Married filing jointly is $31,500. Seniors already had a boost to take them to the $34,700 if you're married filing jointly. But then, if you remember, Logan at the beginning talked about that extra age 65 bonus we can get. Really what the number comes down to is $46,700 if we're married filing jointly and both over the age of 65. We don't pay any tax on that first portion of income, which for a lot of families is pretty sizable. So kind of the takeaway at the end of this is there are for sure opportunities that we can look to try to, what I'll say, maximize these tax brackets. Even if you don't want or need the funds, it's an opportunity for Roth conversions, which your advisor may have already talked about you with in the past. But at the next meeting, it for sure should be at least something that gets brought up again. And then where I go from here is these numbers sometimes are good for us conceptually, but I think looking at an example helps put things in place. So the next slide is super basic in the sense I just assumed a single taxpayer who's taking $100,000 out of like an IRA or 401k pre-tax account. So forget Social Security, forget working wages, forget state income taxes. All we're looking at is federal in this example. So if things would have sunsetted, the example on the left, you can start with the gross income, start taking out the standard deduction. The PE there is what was called the personal exemption that existed at that point in time. I was working with Chad here, the CPA, and he said, if you want an apples to apples comparison, that technically did exist back in 2016 and 2017. So we threw that in there. Long story short, though, your taxable income regardless is still higher, and you can start looking at what you would pay in each of those tax bracket ranges to get you to the $16,258. After the changes with the larger standard deduction and the lower marginal federal tax rates, you're looking at an approximately $3,000 difference in total federal tax paid. And we like to say it's money still in your pocket or still in your investment accounts to grow for the future. And that really gets back to the point kind of what's my goals and objectives long term. If it's money for you, awesome, great. Or if it's things that it's like, okay, I do want this for church, charity, whomever, beneficiaries, for sure a conversation you'll want to have with your advisor at your next meeting to try to maximize this. Lastly, this was not a part of the One Big Beautiful Bill. This is a state of Michigan legislation. It was the lowering MI cost plan. Actually started a couple of tax years ago, but we thought this seminar would be a good enough place to provide the information to anybody who attended. For those who aren't aware, the state of Michigan is in a slow, but starting next year, it'll be fully phased in program to start exempting some dollars that we take from either pensions or IRA distributions, so they're no longer subject to state income tax. The chart here gets a little bit confusing with all these 25%, 50%. I'd focus on the column all the way to the right because everybody, regardless of age, will be eligible for the full amount of the exemption, which we don't have the 2026 number yet, but if you look at the very bottom of the screen, the 2025 limits for a single filer is just shy of $66,000 and married is $132,000, just shy of it. What does that mean practically speaking? I'll just use the single example because I think it will hit home. Married is the exact same way. If I'm an individual who's either taking IRA distributions or has a pension, the first $65,000 worth, I owe no state income tax, which right now is, you're talking 4.25%. Pretty powerful as well. So when you start combining that with some of the things on the One Big Beautiful Bill, a lot of our retirees especially are probably finding they're at very, very low tax rates, both at a state perspective and a federal perspective. And it's all looking at least in our opinion, the state of Michigan at least is probably trying to keep retirees here in Michigan so many have started to make their way down to Florida. One, because the weather's better. I don't think we can ever fix that. But state income taxes in Florida were 0%. So for a lot of people, that could be a big sway. So hoping to keep retirees here in Michigan, or having people come to Michigan, and I think it's a good way to do so. I would say before I drop off and I think Greg's going to wrap things up here, where everything puts is, well, at least with the one big beautiful bill, a ton of new implications. Do all of it apply to everybody? Absolutely not, but there's some pretty large changes. Even if it's the next 4 years, there's a lot of awesome planning opportunities with that extra age 65 deduction. The auto loan interest is pretty cool. The state of Michigan rollout here, which is, knock on wood, going to be for the foreseeable future. It's for sure going to be kind of a three-headed approach of working with you guys, your advisor, and as well as your tax preparer, because some of this stuff gets a little bit nuanced. And the whole point of the Tax Cuts and Job Act before was more and more people were starting to itemize, and that came with its own set of headaches for keeping track of receipts, all of that good stuff. If people do the standard deduction, it's easier, but then this one big beautiful bill threw in all these extra special deductions you have to keep track of. We're not tax experts here, and it's always good to have somebody else in your corner. So kind of that three-headed approach, I think, will be valuable going forward. But as everybody else has hinted on, question and answer box is hopefully working. Feel free to throw things in there. And for anybody potentially interested, we do have copies of these slides that can be made available for those. I think our last slide has all of our contact information. If not, give a call into the office and Vanessa can get you directed to who you need to be. So I'll end here and I think Greg's going to hop back on and wrap things up.
Yeah, I think we missed a couple important points at this workshop. First off, go Tigers. The Tigers won 9-3, in case we missed that, number one. Two, we didn't sing happy birthday to Brett. So for everyone attending, today's Brett's birthday. So next time you talk to him or see him or shoot him a text or an email, wish him a happy birthday. Before we open up to Q&A too, real quick, I just wanted to recap or reiterate, a lot of the content that's in there is, some of it's not relevant to all of us and some of the Medicaid stuff, but the point Adam was just discussing, taxes and tax planning. So these are some big opportunities for us, especially for those that are 65 and beyond. And I think we really want to, begin looking at tax planning is every bit as important as investment planning. If we can reduce the amount of income tax we have to pay both legally and ethically, it's more money in your pocket to direct other places, as Adam mentioned, in, looking forward. For those of you that are 73 and beyond, where we have to take what are called required minimum distributions. These are things we need to keep on the radar. So right now, if our income, if we're in a 12% bracket, but if we start looking down the road saying, gosh, if our investments continue to grow in a year or 2 or 3, or when I have to start taking required distributions, those large distributions may bump us up into a 22% bracket. As the folks mentioned, should we start taking money out today if we need it? If we can do it in a lower bracket, that may make sense. If you don't need the dollars, looking at Roth IRA conversions can make a ton of sense. And it's just, again, an important piece. We've got some of these additional deductions that are good through 2028. So I think really the next 4 years is something we need to be taking a hard look at tax planning for, everyone taking distributions, considering future required distributions, and to try to cut taxes anywhere we can. So with that, I see Joe popped on here, and I know Logan, hopefully Logan, you've got some Q&A. We can kind of walk through that, and we can all stay on board here and kind of field questions as folks have them.
Yeah, and so that nobody feels like they need to go in and ask this question, Adam is looking for new chairs at the office, and he wants to be paid overtime only and all in tips. So he's trying to maximize as much as he can. So he's just mad he's got the squeaky chair.
Yeah, gonna pay no tax over the next 4 years, Joe. That's the goal here, right?
Right.
So Logan, are you there? Do you have some questions for us, Logan?
Yep, I'm here. So looks like 2 questions. One about making the presentation available. Yep. So if you just call into the office, or if you have any of our emails, shoot us an email or call in, and we'll get the slideshow to you. Other question on here is probably best for Adam to answer. It says, is there a phase out on the Michigan pension deduction?
Yeah, so the only phase out, if you will, is if your pension/IRA distributions are over that exemption amount. So if you go back to that slide, Logan, if you don't mind, I think it's back from where you are maybe.
Yeah, I'm gonna try my best.
Okay. Greg can help you with the computers. He's the IT guy here, I think.
Right.
So at the very bottom, if you can't see it, I apologize, but the 2025 exemption limits for the singles is at $65,895. So if my IRA and pension, if I'm a single person, are less than that amount, I am not paying any state income tax. But if you find yourself, let's say it's a year where I'm going to buy a new house or whatever the scenario is, and you take out $150,000 from your IRA account, for state tax purposes, you're going to owe tax on the excess above the $65,895. If that still does not make sense, feel free to put another question in the Q&A, but I hope that is answering what the phase out meant.
Yep. All right, next question up here. This one might be for Sharon. It says, is 529 plan contribution good for grandparents to deduct? So it might be asking, is the 529 plan contribution a good thing for grandparents to do?
As far as anybody contributing to children's education, I would say absolutely hugely important. So the 529 plan, as far as deductible, it's only deductible on the state side. It's not deductible on the federal side. And it is all depending on who contributes to it and things like that. So yes, it's somewhat tax deductible, but it's not a massive amount in the grand scale of things.
Yeah, I think they're capped. So on the 529s, like through the Michigan sponsored plan, if we're using a state sponsored plan, so it's not just any 529 plan, we have to be using a Michigan sponsored plan.
Yep.
And they are, to Sharon's point, they are tax deductible up to $10,000 in state tax deductions for married filing jointly, $5,000 for a single taxpayer. So yeah, there are tax benefits.
All right, next question. It's about Medicare, Brett. So get ready. It says, any known impact on Medicare payments?
Yeah, so as far as I know, as part of the big beautiful bill, there was no changes to Medicare payments. For 2025, it's $185 a month is your Medicare Part B premium. That is dependent on income. There's some IRMA limits depending on your gross income determines your Medicare Part B premium. If you're married filing jointly, I think it's over $212,000 a year. That would begin to increase your Medicare Part B premium.
Well, that's a good question too. And just from a tax planning perspective too, with some of these tax rates, anytime looking at Roth conversions, that does create taxable income. So making sure that, converting, we need to look at the tax rates, but to Brett's point, that's a good question regarding Medicare, making sure that the conversion tax-wise there may be some benefits. But if we hit these thresholds, as Brett mentioned, I think it was for 2023, they're always looking at 2 years prior income. And so in 2023, I think the cutoff was 212. So if somebody, if their tax advisor said, go ahead and convert, there's some benefits, but they didn't consider the potential increase in Medicare premiums, that can come into play. So, we just want to, if we're converting, I want to make sure it makes sense tax-wise, number one, and number two, make sure it's not going to affect your Medicare premiums in the future. If it does, that ahead of time. So good question, good answer, Brett.
Yeah, I feel like this doesn't really apply to that question, but I know a lot of the government shutdown stuff right now is revolving around changes to like Affordable Care Act subsidies. So that may have been what somebody is or isn't thinking. And yeah, a stalemate right now is the best way to describe that. But I know one side is wanting to keep those subsidies in place, and it'll probably find its way some way in the middle. But as of last I knew, there was no insight on that. But that's kind of really been the slowdown, is trying to see who's going to, I'll say, pay first, I guess, and where that ends up for those who are on the Affordable Care Act. And if your income falls in certain ranges, you do get government premium subsidies to help offset your costs.
Alrighty. And that is it for questions on here.
Gotcha. Well, good. Well, with that, then we'll kind of wrap up again. If you have questions, our whole team here to support all of you guys. I want to thank you for tuning in tonight. We certainly appreciate it. If there's anything we can do to help next time, again, anytime we got reviews coming up, keeping the tax planning on the docket. Again, I think it's every bit as important as investment planning. Make sure that we're looking at everything that's out there. So we'll kind of, if you have questions, give us a call, shoot us an email. Our whole team's here to support. And again, thanks for tuning in. With that, we'll kind of wrap things up and look forward to seeing you here in the office, and go Tigers.